In part one of this section, we discussed how to measure risk and return, but we discussed it in terms of individual securities. How much return is this one stock delivering? How much standard deviation does this one investment have? Here, we're going to frame our discussion on risk and return in terms of how people truly invest. People tend not to put all their wealth into just one single investment. Instead, they tend to invest in portfolios. So what is a portfolio? A portfolio is just a collection of things. For example, an artist may have an art portfolio, which would be a collection of all the artwork he's created. In finance, a portfolio refers to a collection of assets an individual is invested in. All of the stocks, bonds, gold, silver, real estate, fine art, everything that someone's invested in will be their portfolio. Here's Bob's portfolio. He has about $45,000 invested in various assets. He has some treasury bonds, Amazon US Steel stock, some corporate bonds, some gold, some international stocks. This portfolio is representative of Bob's total wealth. And Bob should be more concerned about how things affect his total wealth rather than just the performance of any one particular asset. So, if Bob is making an investment decision, let's say he's considering buying Facebook stock, he should be concerned not about the risk and return of Facebook itself. He should be most concerned about the effect of Facebook's risk and return on his total wealth. That is, the effect of Facebook on his portfolio. So we're going to spend our time here discussing the risk and return measures from part one in the context of portfolios. First, the return side. Just like we computed the expected return on an individual asset before, we can do the same for a portfolio. To find the expected return on a portfolio, we simply take the expected returns of each of the individual assets in the portfolio and weight them by the proportion in the portfolio. We should already be familiar with computing expected returns for individual assets, so the only thing new here will be the weighting. Let's do an example to see how this works. We have two securities in our portfolio. We have $30,000 invested in Durable Corp and $70,000 invested in Bright Corp. And we have expectations about the future. We think there's a 25% chance the economy will be good next year, 60% chance it'll be okay, and a 15% chance that it's going to be bad. And in each of these economies, we have our forecasted returns for each of these two securities. The first step will be to find the expected returns for each of the individual securities in the portfolio, Durable Corp and Bright Corp. So for each stock, we'll multiply the probabilities of each of the economies occurring by the returns for the stock in that economy. For Durable, we get an expected return of 10.5%, and for Bright, we get an expected return of 10.7%. Once we have the expected returns for the individual securities, we figure out their weights in the overall portfolio. We have a total of $100,000 invested, and $30,000 of that is invested in Durable Corp. That's 30% of our total investment put into Durable. So the weight is 30%, 0.3. And for Bright, $70,000 of the total $100,000 is invested in it, so the weight in Bright is 0.70. Lastly, we need to put it all together to get the expected portfolio return. In our portfolio, 30% of our money is expected to get the return of Durable Corp, which was 10.5%, and 70% of our money will get the return of Bright Corp, which was 10.7%. So our portfolio expected return will be the weighted average of the two investments, which gives us a 10.64% expected return on this portfolio. We now have a measure of return for a portfolio. Next, we need to develop a way to measure the risk of a portfolio. That's going to be portfolio standard deviation. For portfolio expected return, we can simply weight the individual returns by its percentage composition in the portfolio. But for portfolio standard deviation, it's not quite that simple. The portfolio standard deviation will depend on not just the individual security standard deviations, but also how the securities move together over time. This will be represented by the correlation or covariance. Here's the formula to estimate the standard deviation of a two-asset portfolio. As you add more and more assets into the mix, the formula becomes longer and longer, but for our purposes, the two-asset case will be good enough to get the point across. We can focus on the second version of the equation, where it says the standard deviation of the portfolio is the square root of the weighted standard deviations, that's the part circled here in red, and this component here circled in green. Notice the last term is the component, the Greek letter rho, which stands for correlation. So the standard deviation of the portfolio depends on the individual risk of the securities as well as their correlation. Since correlation plays a part here, let's look into it a little bit closer. The correlation coefficient is a statistical measure that ranges from -1 on one end, which represents perfect negative correlation, to +1 on the other end, and that represents perfect positive correlation. Correlation measures how two things move together. For example, there's a positive correlation between temperature and ice cream sales. As temperatures increase, people buy more ice cream. And there's a negative correlation between student absences and grades. The more classes someone misses, the lower their grade tends to be. The correlation we're looking at here with portfolios is how the return on two investments tend to move together. When one goes up, what does the other one tend to do? We can see some types of correlations here. First, we have perfect positive correlation. Notice the points align in a perfectly upward sloping line. When stock A goes up, stock B goes up as well. We can look at a couple of points on the graph here to see the perfect aspect of this correlation. When stock A has a 5% return, stock B has a 5% return as well. And when stock A has a -10% return, stock B has that same return too. So there's a 1-for-1 relationship there. Perfect negative correlation is the opposite. When one is down, the other is up by the same amount. Take this point here. When stock C has a positive 10% return, stock D has a -10% return. These first two graphs were examples of perfect correlations, correlations of -1 and +1. Those are extreme cases. Typically, you would see either negative or positive correlation, but not perfect. Correlations, as you can see in the graphs here, there's a positive or negative relationship between the stock returns, but it's not so strong that you can draw a perfectly straight line through all the points. Let's now create a portfolio to evaluate its standard deviation. I'm going to form a portfolio which contains a stock of two companies, Merck and IBM. I can get historical data on Merck's stock returns and compute its standard deviation as 6.75%. And I can do the same for IBM and get a standard deviation of 5.22%. These two standard deviations tell us how these stocks tend to fluctuate over time individually. But remember, the portfolio standard deviation also depends on how these two stocks move together, their correlation. I can use a computer to get the correlation of IBM and Merck, and I find that to be 0.178. So it's a positive correlation. When IBM does well, Merck tends to do so as well. But the relationship isn't too strong. Compare that 0.178 with some other correlations we see here. For example, the correlation of IBM and Apple is nearly twice as strong. That implies that even though Merck and IBM tend to move together, Apple and IBM move together much more closely. Now we have nearly all the information necessary to compute the standard deviation of this portfolio. The only remaining piece are the weights. How much of our money will go into Merck and how much will go into IBM. Let's say we'll split it half and half. 50% of our money goes into Merck and the other 50% will go into IBM. So the weights for both are 0.5. We'll also take the standard deviations we computed before and the correlation we found and simply insert that data into the formula. And we get a portfolio standard deviation of 4.6%. If we look closely at this result, we can notice something interesting. We can see that the portfolio of Merck and IBM is lower than both of the individual standard deviations. But why is that the case? How is the combined portfolio less volatile than the securities that went inside it? The key is the correlation. Take a look at the graph here and try to observe the extreme returns. The highest and lowest return on this portfolio. The high is about 15% and the low is about -10%. Now look at the individual securities. Here the extreme returns on the individual stocks range from about +20% and -20%. So what happened here? What happened was diversification. The main idea behind diversification is that good outcomes can cancel out bad outcomes. We can see that play out here in this simple example. Imagine two stocks you can invest in, stock W and stock M. If you invested all of your money in stock W or stock M, you'd be in for a roller coaster ride. Some months you're up and some months you're down. But if we put a portfolio together where we split half of our money into W and half into M, the portfolio WM will produce the results in the third graph. But how? Well, in the first month when stock W is up 25%, stock M is down 10%. So what's the result of our portfolio in that month? Well, it would be up 15%. That's the 25 minus 10. The following month, W is down and M is up. So the net result for the portfolio is a positive 15% return. So good outcomes in one stock cancel out bad outcomes in the other. And the end result is less volatile outcomes with the portfolio, which means less standard deviation. And that's what happened with our Merck IBM portfolio. Some months when Merck was down, IBM was up. So the good cancels out the bad. Forming portfolios gives you the benefit of reducing risk. As long as the investments don't have perfect positive correlation, adding more stocks to the portfolio will reduce the portfolio standard deviation.